So maybe you get to retirement, you've established a large brokerage account. You can then take your capital gains credits as you're selling off things to live on. You don't have any income tax.
Right.
If you don't have any income tax, that allows you to do other smart things like start converting from IRA to a Roth.
Right. Exactly.
During that time period. So these are all things. This is the value of a financial advisor, right? These are all things that you can do, start planning for now that creates these great opportunities 10 years plus down the road. Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is Shawna Theriault.
Correct.
I got it right.
Good job.
I've been practicing that all morning. Today, we're going to talk about different ways to avoid having to pay capital gains tax. And for those who don't know, Shawna is about 1 month in here at Wiser Wealth Management. Came with lots of knowledge, CPA, CFP, CDFA, and a bunch of other scrabbled words. But very happy to have Shawna here. In fact, something happened recently where I almost cried. I was like, she came to a meeting and she was like over prepared. I was like, I'm not used to this. I have to do all this stuff.
That's what planners do. We prepare.
That's right.
Right.
That's right. So I'm happy to have you here. And Shawna's calendar is booking up fast. I think others have found out you're here too.
It is, yes. Glad to be here.
Okay, so today's topic is going to be capital gains tax.
That's my favorite tax.
It's your favorite one really to pay dorky. Or the favorite one to try to skip?
Both. No, not to skip, to pay probably. But
well, let's talk about what capital gains tax is just to make sure everyone's caught up with us.
Absolutely.
And how that's different from income tax.
Absolutely. So capital gains are anything that's appreciated, a security that you buy. Let's say you bought a stock at $10,000 and it appreciates to $20,000. You now have an unrealized gain of $10,000 that you don't pay tax on until you sell it. So if you were to sell that security, then you have a capital gain that you have to pay tax on that. But the difference is, and this is what I like about it, is that it's at lower tax rates than the ordinary income rates.
Right.
So it really just depends on what your other income is.
So it could be zero.
Could be zero.
Could be 15% or 20%.
Right. So even if you're in
23.8%.
That's true. Yeah, Medicare surtax. Right. So if you're in the highest tax bracket, it goes to 20%, but that's still way lower than 30 plus. So,
true. Yeah.
Yeah.
So not something you should be scared of, but you certainly need to navigate and understand how this works before you make any sale decisions related to real estate or stocks and bonds and all that fun stuff.
Absolutely.
All right. So let's talk about short-term versus long-term capital gains. So there's two different categories.
There are. And so it depends on the holding period. So when you've held something, real estate, stock, something in a brokerage account, less than a year, that's considered short term, and that would be at ordinary income rates. So in that example, you wouldn't have the 0, 15, 20. It would be wherever the tax bracket is, you would pay the gains there, the tax there.
So if you bought NVIDIA and you sold it 2 days later or a month later or 11 months later,
right,
you'll be taxed at your normal income rate.
Right.
So if you're in the 24 to 37% bracket, you're going to pay 24 to 37%. Where if you had held it in my 11th month example, one more month past the 1 year mark, you would have been taxed at the 0, 15 or 20%.
Right. Then becomes long-term.
Yep.
Absolutely.
Okay. That seems pretty simple. So what are some ways that we can even take this a step further, avoid having to pay capital gains tax?
Tons of ways. So you can hold on to the security forever, right. But that's not always the best thing either. It's, clients will say to us, I don't want to pay any tax, but I want to make money. If you're paying capital gains tax, that means you made money. It is good and judicious to take gains off the table and rebalance sometimes, but you could hold on to it to avoid the gain. So if you don't sell it, you don't pay capital gains tax.
Right.
You could gift it to a charity. That's one of the things that I really like, is if you're already charitably inclined, you could gift appreciated securities to a charity and avoid the capital gain while getting the tax deduction, and the charity doesn't pay the tax on there.
Yep.
You could sell for losses in your portfolio and tax loss harvest. The other things, maybe NVIDIA, we know went straight up. Maybe there's other stocks that are down. So you could sell those to help take losses to offset capital gains as well. So they offset one another. So that's a way to help with the overall tax portfolio. I know we do that with direct indexing. So
Yeah. Direct indexing is exactly why we deploy that. Is it, if you think about the S&P 500 over a 1 year period, you're looking at over the last year, really 7 stocks is what drove the S&P. So
right.
if you got 493 other stocks that either were flat or were down, and so you can take those losses on the downside and then, take those credits into your tax return.
Right. So, exactly. And then carry them forward if you don't use them all. So
correct. The capital losses will carry forward year over year. So the max you can deduct in 1 year is
$3,000.
So if you have $100,000 in losses, you can only write off $3,000,
right.
but $97,000 in credits will carry forward to the next year. And then maybe the next year you sell something for a $60,000 gain. You're not going to pay any tax because that $97,000 credit is still sitting there.
Right. So it's just going to offset it and just keep carrying forward. So,
which is why you do direct indexing.
Right.
Because in the end, you're creating these credits over time. So maybe you get to retirement and you've established a large brokerage account. You can then take your capital gains credits as you're selling off things to live on. You won't have any income tax.
Right.
If you don't have any income tax, that allows you to do other smart things like start converting from IRA to a Roth.
Right.
Exactly.
During
that time period. So these are all things. This is the value of a financial advisor, right? These are all things that you can start planning for now that creates these great opportunities 10 years plus down the road.
Completely. Absolutely. So
let's talk about the gift and inheritance strategy. Really, those are two different strategies.
They are.
Let's talk about the gift one first. So if you had highly appreciated assets, instead of selling those, so maybe you write a $10,000 check to a charitable organization.
Right.
Right. So if you do that, instead of writing the check for $10,000, you could gift these securities.
Correct. So instead of, like you're saying, hitting the cash flow and writing the check, just gift the appreciated securities. Mm-hmm. So take 10,000 of NVIDIA, just making it up, give that directly to the charity. You can't sell it first because then you would incur the capital gain. Gift it directly to the charity. And then, they don't pay the tax, you don't pay the tax, and you still get the tax deduction on that.
Then you can take the $10,000 out of your checking and put it into your brokerage account and then reinvest that. Now you have more of an efficient investment strategy.
Absolutely.
Okay. And then if we want to add to that inheritance, so what happens when you pass away with capital gains?
You do get a step up in cost basis. And so what does that mean? It is, in the same example, if you have $10,000 worth of a $10,000 cost basis in a stock and it's now worth $20,000, if you were to pass away, and it matters how the asset's titled, by the way, but if you were to pass away, it gets a step up in cost basis to the current value. So it basically wipes that gain away. So there's a couple strategies there. If someone is ill, if we know that they're not doing well, I've done strategies where you can move assets to their name individually, maybe from a joint account individually, because maybe they have been diagnosed with something and something happens to them and they get a step up in cost basis on that whole account. That is a strategy, or just in the normal, let's say you don't have cost basis on a stock and it's been sitting there forever. Those are the ones I love to give to charity, or just hold on to them as long as it's less than 10% of your portfolio. Hold on to them and they get a step up in cost basis, when you pass away.
So if you're inheriting assets that they've been in the family for a long time,
right,
you get a step up. There's a family that was here. They're still here at our firm, but for whatever reason, for like 3 generations, they kept gifting the stock before they passed away.
Oh,
They just wanted to like, no, I want you to have it. I want to see your
Yeah.
face when I give it to you. I was like, somebody's got to stop this.
Yes.
You've got to wait till you pass away to let the
because because if you gift it to someone, the cost basis carries with it.
We had a cost basis that went back like 30 years.
Right. Exactly.
Looked really good on paper, but no one could really sell it because it would just cost so much.
Well, there's many individuals that are passionate and about their stocks, know, and they don't want to sell them.
No.
I understand that.
So let's shift gears just for a second and talk about real estate. So we've talked, you think about stocks and bonds, we use NVIDIA because that's a hot stock right now. But let's say you buy a beach house or a mountain house, doesn't even have to be in a rental program necessarily, just needs to be a second property or third or fourth, right?
Right.
And, real estate is one of the best inflation hedges.
Absolutely.
And so your home is increased in value, but now you want to sell the home and you want to buy a different home. So most people, I think, go out there and they sell the house, they get the money, they pay capital gains tax on the sale, right?
Right.
So what they paid for it. Now, if you rent it out, that's a double whammy because you've depreciated the house probably over 10, 15, 20 years.
Yes.
So you have to add that back to
recapture
your basis. So
yes.
you end up paying a lot of tax. And you sit on the money for a while and you go, man, I really miss that lake house. Maybe we should buy a different one somewhere else.
Mm-hmm.
And then you go out and buy a house. That's probably the most inefficient way to do that, isn't it?
Oh, absolutely. Absolutely.
What should we be doing?
Well, you can do what is called a 1031 exchange, where you're taking one property, like kind property, and selling it and buying another one. So the gain stays in it. There's a couple different nuances with it, but the gain stays in it for all intents and purposes, and it kind of carries to the next investment. That is a very structured type of transaction. So you want to make sure that you have the right individuals helping you with that.
Right.
And there's parameters around that, but it is very powerful.
So there's some odd things. If you bought raw land and you can't exchange that, you can't do a 1031 exchange into an improved property.
Right.
So you'd have to go from raw land to raw land. You could go from a business sale. So you could sell your business and do a 1031 exchange. If it's I want to say if it's a pure stock sale versus an asset sale, that does change it. So if it was an asset sale, you could then take that money and then purchase a home with that, like a second home, not your primary home.
Right.
If it's a stock sale, you can't pull that off. So most people, when they sell their company, really, they aren't selling the stock. They're selling
the assets,
goodwill, what have you.
Right.
So that's a way to transfer money out and keep from having to pay the capital gains tax, right?
Yeah.
And also that's a super advanced strategy. So you'd have to get with a CPA before that one because you have to be able to get part of that sale as to be set up correctly.
Right.
They can't sell your goodwill and then convert it to real estate.
Right.
It'd have to be an asset in the company. There's an exchange. So I'm trying to think through this. There's an exchange. So typically people have to pick out, 5, 6, 10 homes. They go to the exchange and they say, hey, I want to do this. Here are the homes that I want to purchase. And then they approve those. And then you just have to close on them within a deadline.
Right.
So you just don't go sell your home.
No.
Like I've had people call me and say, I want to do a 1031 exchange. I said, great. Let me find you someone that can be your intermediary for that. And they go, oh, we sold the house last month. I was like, it has to be written into the contract.
Yes.
You can't, it's too late. You have to be thinking about this before the for sale sign goes up in the yard.
Right. It's very structured. So, and there's time parameters around it too.
Correct. And you'll pick up there's some fees involved, but nothing compared to what the tax is through the process. And there's a few people in Atlanta that do it really well. I'm sure a quick Google search, you would find other probably attorneys that would do it on the other side, other states as well. And with
your primary home, you mentioned this. So not the primary home. So the primary home, we have built in thresholds that we can avoid, a specific amount of tax exemptions, if you will.
So is it $250 per person?
It is. So it's $500,000 for married, filing jointly. So what that means is let's say you bought your home for $200,000 and it is appreciated to $500,000. You have an unrealized gain of $300,000. If there's two of you, you have $500,000 exemption. So you go to sell it, and there's no gain on that. There's no tax. There is a gain, but there's no tax due on that
unless you've made over $500,000.
Right.
So that's your purchase price, right?
Plus
your
improvements.
Plus improvements. So that's your base.
Plus realtor fees.
Okay. Yeah.
So like the 6%, that can be significant in a larger home.
Yeah.
So you would the seller pays that.
Right.
So it's your basis plus any improvements. I don't mean maintenance, but kitchens, bathrooms, any capital investments like that.
Roof.
Yeah.
HVAC.
And then the realtor fees on top of that. And then you take what is that cost all in compared to what you sold it for. And that is your gain. And that is where you have to compare it either to the $250,000 or the $500,000 to know if you have that, where your exemption falls. So most individuals don't pay capital gains tax on their home.
Yeah. We're starting to see a little bit more now with the prices.
Appreciate that. I could see that.
Yeah. We've had clients out in Colorado, pay $800,000 for a home, and 5 years later, they're selling it for $3.5 million.
Yeah.
Which is crazy.
Yeah. But again, you made money, you won.
Yeah,
so, you don't want to say, I want to wait until it goes down and I don't owe taxes, because you're still making money, and it's still a lower tax rate if you've held it for longer than a year than ordinary income.
Especially when it grows that fast. So when it grows,
right.
It's different.
Right.
If it does it over time, that feels different. That's one thing that's not really indexed for inflation, though. It was just interesting. The 500,000, the 250.
It's not.
It's just been that way for a long time.
It has. Yeah. I wonder if it's just because most people don't pay that. And then, most people do own a home too when they pass. So that step up in cost basis still applies there.
Yeah, that's true. Yeah,
so if it's joint and one of you passes away, half of it's stepped up. And then when the other one passes, the other, it's stepped up again.
Yeah.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
Let's talk about tax-exempt securities. So municipal bonds would be one of those.
Yeah, absolutely. So you could avoid, capital gains and interest payments or tax on interest, things like that, by holding them. You really want to look at the tax equivalent yield, though, meaning look at the total yield or the potential growth there.
Yeah.
A lot of individuals hold bonds to maturity. Usually you don't usually sell them. But if you have, other tax exempt securities, you want to look at the tax equivalent yield. It's like, okay, is the yield smaller overall, even though if I'm saving tax, is the yield better in another security, even considering the tax? That would still be a better play in your portfolio, because your total return net of tax would still be higher, potentially could be. So that's what you want to look at.
True. Those are calculations that portfolio managers do all the time, but I don't know that, they typically will use a general tax rate where a financial advisor should be able to know what your actual tax rate is to decide if that's the best strategy or not.
Absolutely. But again, that's a good point right there. Understanding your whole tax picture, just because you have a lot of assets doesn't mean you're in a high tax bracket. So let's say you're newly retired and you have maybe Social Security, some pensions, and you have dividends, but your paycheck stopped You're not taking distributions from retirement accounts
Right.
yet. So your income bracket may be low. So maybe those are the years that you exit some of the securities that have gone up if you're not charitably inclined, or maybe you've already done that and there's still more to go. Those may be the years where you're in the 0 to 15% tax bracket for capital gains.
Right.
So maybe that, understanding your whole picture, just because you do sell something doesn't mean the tax bill on that is huge.
No, and that's where so many financial advisors are missing out on. I'd say 95% of advisors are going to say something like consult your tax advisor, and they don't do any strategy inside portfolio management to take care of taxes.
Right.
It's very unusual that you find a firm that really thinks about that. And that's because most firms are built to sell stuff. They're built to sell you the mutual fund, to sell you the annuity, to sell you the
right.
If you looked at it from a tax perspective, annuity is probably one of your worst investments to make, just because so much of that builds up and you're passing all this tax to the next generation. But the overall strategy, I think, in financial planning has to have a tax component to it. That's very, very important. And I think that's the part that gets missed the most.
It does.
Even in our planning software, there's tax components built into it.
Oh, absolutely.
But most advisors are afraid to touch it because, I'm not a CPA. I'm not.
Right. You don't want to give the wrong advice.
Right. Exactly. When it's no different than advising on their property casualty insurance, you just have to understand how it affects them, and doesn't mean you're preparing and signing the return.
Right. Two different things.
Two different
Completely.
things. You understand the tax strategy.
But taxes are very complex. And so, they can be. And if you've never run a tax projection or inputted the numbers, you don't really know how it affects one another sometimes,
That's correct.
And it's different transactions do different things. And so that's honestly, Casey, that's exactly why I took the CPA exam and got my CPA. It wasn't so that I could prepare tax returns, all that I can. And, I love all things taxes. It was so I would understand the ramifications of the recommendations I was making, because it's very powerful. If you're saying I recommend to do this, well, how does that look in April?
Right.
You have to prepare for that.
Exactly.
So that's exactly why I did it. So
and
I would
so many
understand
CPAs that do taxes really don't do planning.
Right.
They don't have all the pieces to the puzzle.
Right.
That's the part that you have to have CPAs and financial advisors to work together, because a CPA does not. They can do tax planning, but they have to ask a lot more questions, and most of them aren't asking a lot more questions.
Yeah.
Right.
Yeah. No, completely.
It's just it's a tax mill. How many tax returns? Because you're getting it's a transactional relationship. They're getting paid to do the tax return.
Yeah.
But then to find one that asks the right questions and helps you do some planning, it takes two.
Yeah.
We have some of the best tax preparers in our partnership here with Sudi CPA, and then we have a firm in Atlanta that just started with us. Those guys require, and one gal there require us to send them. This is what we're thinking, and then they kind of endorse that. They don't have enough information to do real in-depth tax planning.
Absolutely.
So it takes coordination amongst all the
advisors.
All the advisors.
Completely.
Exactly. So what do you think there are the potential pitfalls or mistakes that people should be avoiding when it comes to capital gains?
Making sure it's long-term. There's no reason in your example to sell it at month 11, unless there's an underlying reason and you think that the stock is going to tank and, it's just a bad investment or something. You don't want to hold it to make it long-term if you think it's going to go down, So there's always some reason to do it quickly, potentially. Gifting appreciated securities, highly appreciated, something that's been held for 30 years to other family members, definitely avoiding that, I would think. In the example of the gifting to charities as well, make sure that's long-term as well, because what happens if you gift securities to a charity and it's less than a year holding period, then you only get the deduction on the basis and not the total. So making sure even if you're gifting it to a charity, it's long-term.
Okay.
Entitling matters, meaning, let's say you have husband and wife and all the assets are in his name. And sometimes you do that on purpose because, somebody's a doctor or, for liability purposes. There's other ways to do it too. But, there's intentionality there. There's sometimes intentionality. And so, but just knowing that if someone falls ill or suddenly passes away, if everything's in the surviving spouse's name, there's no step up in cost basis on those stocks.
Yeah.
For the person who passed away, because there's nothing in their name.
Right.
So that's, thinking, I know that's the last thing you're probably thinking about during those times, which is, why you prepare in advance as much as possible, making sure you have estate documents, all those things, but just paying attention to the estate plan and how things are titled. That's very important.
Okay. Great. Thank you.
Yeah.
All right. So we've got a couple other podcasts you guys might be interested in. Episode 150, Can Tax Loss Harvesting Improve Investing Returns? We also have a YouTube channel, A Wiser Retirement. Actually, a lot of people have been watching the podcast, which is crazy. I'm start dressing up. I just wear these golf shirts. I'm going to start dressing up like Shawna over here for the YouTube guys. But we have 2 videos there linked in our podcast notes here. Here's how to avoid paying capital gains tax. Do you have to pay capital gains tax on inheritance, or do you have to pay taxes on inheritance? Those are all links there. And then we have a great blog. I think that's fairly recent. Tax saving strategies for high income earners, which is on our blog at wiserinvestor.com. Thank you, Shawna, for coming in and doing this with me. And thanks for watching. We'll see you guys next time. But wait, we have a little bit more before we go. Back off of his Delta ride back home is our very own king of data, Andrew Pratt. Andrew was on a conference or a speaker at a conference for DAC FP, the Vision Conference. I think it's the largest crypto conference right now.
It's a big one.
It was out in Austin. Mm-hmm. And that was cool. We sent Robert to,
right.
I haven't gotten any pictures from Robert yet. And we just talked to him I just did a crypto podcast with him, and he gave us his feedback of the event. I totally forgot to ask him for pictures and video, but what was your biggest takeaway?
So, the conference, it was geared more toward educating advisors. So Robert, I think, was, disgruntled a little bit because it was kind of a quote unquote Bitcoin maximalist conference.
Well, on a scale of 0 to 10, Robert's a 10 as far as knowledge of all this. He's way ahead of us.
Yes, definitely. He's more forward thinking.
So yes.
And, I was trying to sort of, rein him in. I was like, this is really more about, educating advisors about Bitcoin, because that's the easiest crypto to understand, and just sort of introduce it to. There's a lot of people in the audience that had no idea really or where to start as far as like incorporating it to portfolios, and it was great. I mean, there's Michael Saylor, the CEO of MicroStrategy. He was one of the keynote speakers. He video conferenced in from Hungary. So it's just great to kind of hear his rationale and his a different perspective. Rick Edelman has he's done a webinar out on his price prediction for Bitcoin at the end of this year. It's a little lofty, but really the backstory behind that is if there's 1% global adoption of Bitcoin, he thinks there could be an upward price target of 420,000. Again,
by year end or sometime next year.
Yeah, year end is his. I think he admits it's a little lofty, but
not as lofty as others. I mean, there's people out there at 1.5 million, 3 million, 5 million.
Yeah, but I think for me it was good just to kind of hear some different different areas about the asset class and about the space, and some of the whether it's regulatory or just how other advisors are using it. A lot of them are we're using a third party SMA,
mm-hmm.
and I thought that was interesting. Especially now, I think a lot of them weren't really thinking about incorporating the spot Bitcoin ETFs or other maybe future whether it's Ethereum ETF down the road. So when I was on stage, I actually sort of gave our experience and shared some background around that.
So yeah, our adoption rate here, and for listeners who aren't clients, several weeks ago, we gave the option to add the Bitcoin, the Bitwise Bitcoin ETF to our portfolios, anywhere from 1% to 3%. So if you were basically 100% equity portfolio, you had 3%. If you were a 60-40 portfolio, you got 1%. Below 60-40, you were not offered Bitcoin because we didn't think it really fit the risk profile. But our adoption rate was about what we expected, around 15%. So 15% of our client base said yes. And what was weird is they had a lot of young people, obviously. So people in their 20s and early 30s inside their flight path or betterment allocations were wanting to add that. And then we had our more legacy clients, very high net worth, also adding it on the Charles Schwab platform,
right?
Which is very interesting. So you had the top end that we're putting in is upwards of what, $70,000 into the Bitwise ETF, all the way down to, I think the smallest contributor was $5.
Right. Yes.
So it was, and that was my son, I think, actually. His balance
He's
is
got some big skin in the game.
I think his portfolio balance is like $500 or something like that. But yeah, so it was very interesting. Again, this is not something that I would ever force on anyone because there's so many varying opinions on Bitcoin, and it all just, people just need to understand or be educated about it. And we've been doing podcasts for a year and a half, maybe longer, about Bitcoin and blockchain, and try to educate people as we're leading up to this. Right. So it's not something we just threw out there. It's something that we've been learning about ourselves. In fact, you did the certification. You have a certification in blockchain and cryptocurrency.
Right. The CBDA, certificate in blockchain and digital assets.
So yeah, I mean, that's part of the process is getting things like that to understand what's coming down the line.
Right.
And my thing is 10 years from now, that conference will be one of probably many conferences, not just, one or two conferences a year that cover these things. So it's good. It's good that people were there to go learn more about it.
Yeah. And I think, our approach and what really got me, I've always been open to it. I was a little skeptical adding it to multi-asset portfolios, but, after the course, just seeing that at 1%, small as 1% allocation can make a meaningful impact to risk adjusted returns. And that's what we're really focused on is, how do we maximize our return per unit of risk? And, and what I said at the conference and some research I did on my own is, just taking a standard 60% equity and 40% bond portfolio. If you take 1% away from equities that and put it in Bitcoin over the past 10 years, that increased your Sharpe ratio or your risk adjusted return by over 50%. Now, then if you take that further and you rebalance at a 50%, maybe getting a little too technical here, rebalance at a 50% band, that increases your Sharpe ratio, your risk adjusted return, another 50%. So to me, the math, what's behind it, you're not taking, again, especially for moderate, more.
And if it all goes to zero.
Yeah, it's just 1%.
Not a huge deal.
Moderate models. But, and people always state that there's not enough history, spot Bitcoin ETFs are relatively new, but Bitcoin's been around for 14 plus years. So, I mean, there is a lot of, price history there.
Yeah, absolutely. Well, thank you for your insight, and thank you for being a rock star at the conference and representing Wiser so well. We're glad to have you here.
Thanks, Casey.